Hello everybody. This is lesson 20 of the lecture International Economics. I will discuss slides 86 to 98 of chapter 3 Currency Politics. In this lesson I will explain various possibilities private companies can use to protect themselves against exchange rate risk. In a system of flexible exchange rates, as it has emerged after the breakdown of the Bretton Woods system, a central bank does not have to care for the exchange rate of its currency. Instead, it can focus on other policy targets, for example, the inflation rate. The disadvantage of such a flexible exchange rate system are often quite strong exchange rate fluctuations. Therefore, export-oriented companies which sell a large share of their products to foreign countries are exposed to higher profit risks under such circumstances. This risk represents for these companies a similar transaction costs as tariffs or transportation costs, as the following graph will show. Let's analyze the exchange rate risk of a typical commercial deal of a private company which sells goods to clients in other currency areas, but has to pay for its inputs at home at the domestic currency. Let's assume a car producer, a European car producer, sells a car to a client in the dollar area at the price of, let's say, $20,000, while the production costs for this car equal 900 euro. Since the car producer produces the cars in the euro area, the production costs must typically be paid in euro. So as a result, we have a currency discrepancy. The revenue will come in dollar, while the costs have to be paid in euro. What makes the system worse is the fact that the dollar payment of such an international trade deal will be typically paid in the future. For example, 3 months forward, when the car has arrived at the client overseas and can be expected by the client. A 3 months period for payment is in fact a quite typical term for payment in international trade deals. Now let's assume that the current spot exchange rate equals $2 per euro, while the future spot rate is of course unknown at date 0. Given the spot exchange rate of $2 per euro, the deal would be profitable. The revenue in euro would be $20,000 divided by the exchange rate, which yields 10,000 euro minus the production costs of 9,000 euro, leaves a profit of 1,000 euro to the car producer. However, we do not know what the future spot rate will be. If 3 months ahead the spot rate of the present period would still be given, a profitable trade deal would be possible. However, we do not know what the future spot rate will be. So we do not know what the future profit will be. If 3 months ahead the spot rate, the present spot rate of $2 per euro were still given, we would make a profit. However, a depreciation of the dollar, let's say to a level of $2.5 per euro, is as well possible. In this case, a loss of $20,000 over $2.5 per euro exchange rate would equal only 8,000 euro minus 9,000 euro production costs would result in a loss of 1,000 euro. And this possibility, the risk that this happens, is what we call the exchange rate risk of such an international trade deal. What are the consequences of such an exchange rate risk? If companies could not protect themselves against exchange rate risk, they would only agree in such international commercial deals where the profit margin is high enough such that the exchange rate risk is compensated. International trade with lower profit margins would therefore not be undertaken. Exchange rate risk would thus hamper international trade in a similar way as tariffs or transportation costs do. However, international financial markets offer various possibilities to hedge such exchange rate risks. Thus, these markets support international trade with goods and services. Therefore, most export-oriented companies hedge their exchange rate risks. However, as we will see in the following, this comes at a certain price. 3 basic instruments can be used to hedge exchange rate risk. First, foreign currency credits. Second, currency futures. And third, foreign currency options. I will explain these 3 instruments one after the other in the following. A quite simple way to eliminate exchange rate risk is a foreign currency credit. Let me use the commercial deal just explained 2 slides before to show how a foreign currency credit can be used to perfectly hedge the exchange rate risk. Let's assume that the interest rate for a dollar credit of $20,000 with a maturity of 3 months equals, for simplicity, just 2%. So if you take such a credit equal to $20,000, we can immediately exchange the dollar credit at the current export rate of $2 per euro, such that we can realize immediately an income of $20,000 over $2 per euro, which equals 10,000 euro minus our production costs, 9,000 euro, such that we can realize a gross profit of 1,000 euro. In this way, we can make sure that we have this gross profit without any exchange rate risk. Now, 3 months from now, when we receive the payment for the car in terms of $20,000, we can use this incoming payment to pay back the credit. However, we will need to pay also 2% interest on this $20,000 credit, which equals $20,000 times 2%, which is equal to $400. So what we have to do at T0 is make sure that we are able these $400 without any risk 3 months ahead. In order to make this sure, we have to subtract 200 euro from our gross profit, exchange it back into dollar at the spot rate, which is certainly given at this point in time, and then we will receive $400. Now we have to keep these $400, let's say, in our cash drawer and wait until we need to make the interest payment 3 months ahead. In this way, we will make sure that we are able to pay back our credit 3 months ahead with the help of the incoming money from our sales deal of $20,000 plus the $400 which we have laid back in the present for the interest payment. Now, the final net profit is of course a little bit smaller than the 1,000 euro because we have to subtract from this 1,000 euro the 200 euro for the interest payment, such that our net profit will in this case be 800 euro. But this is a certain profit, so we can make sure that we will have this profit at T0 even though we do not know the spot rate 3 months ahead. In other words, we have completely eliminated the exchange rate risk from this international trade deal. Another possibility to get rid of the exchange rate risk is the purchase of a currency future on the market for forward exchange. Let's assume that the current forward exchange rate payable at 3-month maturity equals $2.1 per euro. So if we sell the $20,000 which are incoming 3 months ahead currently on the forward market at a forward exchange rate of $2.1 per euro, we can exchange 3 months from now the incoming $20,000 at a forward exchange rate of $2.1 per euro. This provides a euro payment of 9,523.8 euro, which equals minus the production cost of 9,000 euro, a net profit of 523.8 euro. So this yields a certain profit also, in this case equal to 523.8 euro. A profit which we can realize in advance for certain without any exchange rate risk. Another possibility to eliminate the exchange rate risk is a currency option, which allows the exchange of dollar to euro 3 months from now at an exchange rate fixed in advance in the present. Let's assume that it is possible to buy an option to exchange $20,000 3 months in the future at an exchange rate of $2 per euro for an option premium of, let's say, $500, which corresponds to an option premium of $5 per dollar. If you buy this option and the dollar depreciates versus the euro to a rate of, say, $2.4 per euro on the spot market, we can use the option to avoid a loss. For example, in this case, we could exercise the option and exchange our incoming revenue of $20,000 at the exercise rate of $2 per euro, such that our euro income in the future will be $10,000. Minus our production costs leaves us then a profit, a gross profit equal to €1,000 minus the costs for the put option of €500 leaves us finally a net profit of €500. But this again is a certain net profit which we will already know to have for certain at point T0 if we make use of the put option. Now comes the interesting part of the story. If, let's say, the dollar appreciates now versus the euro on the spot market at a spot exchange rate of, for example, $1.8 per euro, we could use our right not to use the option and instead exchange the incoming dollar payment of $20,000 at the spot exchange rate of $1.8 per euro. Thus, we would receive more euro for $1 as if we would use the option. At an exchange rate of $1.8 per euro, the $20,000 exchange to €11,111, such that our gross profit would then equal €2,111. As a result, the net profit would equal €2,111 minus the costs for the option of €500, which leaves us with a profit, a net profit now of €1,611, which is significantly more as the €500 we could reach if we made use of the option. In fact, such an option would combine an insurance against a depreciation of the dollar with a speculation for an appreciation of the dollar. So these examples, I think they all show that in a system of flexible exchange rate, private companies do not necessarily have to suffer from exchange rate risk. They have a couple of possibilities which can be used to get rid of such an exchange rate risk. So this is the perspective of a private company which suffers from exchange rate risk and uses one of these possibilities. It is, however, also interesting to analyze what happens with the exchange rate risk in case such an instrument is used. Let's analyze this for the case where a currency future is used to get rid of the exchange rate risk. To do so, let's again use a numerical example, similar to the one we have just used. How could the following companies reduce their sales risk caused by a potential change of exchange rates? Let's assume we have again a European car manufacturer who sells a car to an American dealer 1 month forward at a price of $20,000 payable at the date of delivery 1 month forward. The production costs for this car are 8,000 euro at the current spot market exchange rate of $2 per euro. The company could, of course, cover its costs. Total sales would be $20,000 over $2 per euro, which yields an income of 10,000 euro, enough to pay the production costs and keep a profit of 2,000 euro. If, however, the euro would appreciate to an exchange rate of, let's say, $4 per euro, the company would make a loss of $20,000 over the exchange rate of $4 per euro equals 5,000 euro minus the production costs of 8,000 euro yields a profit of minus 3,000 euro. So this would be the exchange rate risk of this car producer. Now let's assume that the other company is an American manufacturer who sells 100 refrigerators to a European dealer 1 month forward also at a price of 10,000 euro payable at the date of delivery 1 month forward. The production costs for the 100 refrigerators are $18,000 at the current spot market exchange rate of $2 per euro. The company could cover its costs and would still make a profit of $2,000. If, however, the euro would depreciate, let's say to an exchange rate of $1 per euro only, the company would make a loss equal to 10,000 euro times the exchange rate of $1 per euro yields $10,000 minus the production costs of $18,000 yields a profit of minus $8,000. What kind of deal would reduce the sales risk or the exchange rate risk of both manufacturers? Let's assume that the managers of both companies meet by chance on an airport and talk about their exchange rate risk exposure. In such a situation, they could discover the following possibility to eliminate their exchange rate risk mutually. For example, the European manufacturer could sell the American manufacturer $20,000 from the revenue from selling the car to the American market in exchange for 10,000 euro, the revenue of the American manufacturer from selling refrigerators to the European market payable in 1 month. In this case, we would implicitly have an agreement on a forward exchange rate of $20,000 over 10,000 euro, which equals $2 per euro. So this would be in fact a forward contract. And as we can see in this example, this type of forward contract would eliminate the exchange rate risk of both manufacturers to zero. So the risk would have gone. Consequently, given a forward market that allows such kind of deals, manufacturers of different currency areas can completely eliminate exchange rate risk. In this sense, forward exchange markets help to make the world a safer, which means a little bit less risky place. So much for this lesson.